example. It levels the playing field to a degree only from the standpoint of if you are a good business partner, people will continue to come to you before they'll go to somebody else, where maybe corruption is something it's kind of tax deductible as it used to be in certain jurisdictions. But those are the kinds of things that you really can't control, but you have to plan for. And making sure that you are acting in the best possible light, and making sure that you're a good bellwether for business. But certainly you can't control that. I think things like what's happened in Japan is another example of things you cannot control, but it has dire implications both to life and what's in the future. You here in Texas, and we were involved in the South Texas project, that was the nuclear plant that NRG was trying to do. Well, there's not a lot of hope, my opinion, not Fluor's opinion, my opinion, that you're going to see nuclear, new build nuclear being part of the energy equation in the near future. That's potentially damaging, I think, to the U.S. economy and the world economy, because that has to be part of the equation, as is coal and other things. So I think the other thing that kind of fits in there are these natural disasters within the regulations that come as a result of that. And I think that's going to be damaging, I think, when you think about the resurgence of the U.S. economy and where people are going to spend their money.
Before I pass the microphone forward one more step, I want to go backwards because I didn't ask the question the way I should have asked the question. What this conference is all about is access to capital. Duncan, you're sponsoring the conference, and that's really the title of it. And what I should have asked Mike and David is, when you're going through this list of challenges you've got, where does access to capital fit into that list? So, Mike, let me pass the microphone back to you for a second before we keep going forward. I want to get us all on the same page, and I should have done that to begin with.
We're a proud member of the New York Stock Exchange listed company for over 80 years, so that's served us well, obviously, for decades. We're fortunate to not need a lot of external capital at this point. We have over $2 billion of cash on the balance sheet and have continued to have a strong dividend policy, so we're returning capital to our shareholders, and we have been spending as much as $1.2 billion on capital expenditures per year. So we're not a capital-intense industry, quite honestly. Our real estate is essentially built out. We'd like to be building more. If there's a commercial real estate market out there, we'd be happy to go out and raise some capital to build more stores. But at the present time, we don't have a real crying need for additional capital.
David, we'll go back to you for a second.
We're pretty much the same way. We're not really capital intensive. But again, I'd point towards some of the infrastructure build that's necessary in the United States and the world to keep up. Most of the customers that we deal with are in the big oil or power, and actually capital has not been an issue for them during the crisis. But it's that municipality, the needs from an infrastructure standpoint that have taken a back seat. Okay. And it's just going to create a big wave of need, I think, in the near term, that I'm not sure either skill sets, capabilities, or technologies are going to be able to catch up with.
Okay, good. Kevin.
Yes, I think one of the interesting things we've seen over the last couple of years is businesses around the globe, particularly in the U.S., have gotten much more productive over the last 2 years. Profits in many businesses and many industries right now are an all-time high. So while there is some improvement from a sales point of view happening in many industries, we haven't seen a big increase in employment yet. And I think for me, as I look at the environment that's in front of us, and I see that productivity is increasing, that businesses continue to be focused on driving higher and higher levels of productivity, I think we maybe all learned, a really important lesson that'll stick this time, which is, hey, you got to make sure you build a great business. You got to be driving productivity even in good times, because good times don't last forever, right? We had one of these corrections about 10 years ago. I thought, folks had really learned that, particularly on the IT side of the world, which is what's important to me. But I think what we'd seen is that lesson got forgotten pretty quickly, and guys went back to spending a whole lot of money on very expensive technology that may never have had a return on investment that they could see. And so I think what we see from an external point of view is I think that lesson is deeper this time. I think it will last longer. And the folks are going to really scrutinize the money they spend and make sure they can see a return on that investment, and that return is of a level of significance that makes sense for them. that they're going to continue to leverage technology instead of leveraging people. That's good and bad, right? The good thing is that should create a tremendous amount of job opportunities for guys to start companies up, to build technology that continues to drive significant improvements in productivity. I think for us, we look at it as an opportunity to take this business model I already talked about, this unique way of reaching the market all around the globe, of breaking across the barriers most models can't, of geography and company size. We can break across those because we use the internet. As you guys all know, my son is a big fan of playing games on his iPad, and he's playing with some kid in China, which is an amazing concept. Well, I think we've all got to learn how to take advantage of that behavior, because that behavior is going to get larger, not smaller. It's going to be more and more pervasive. So the external thing I see in the environment is how do you take advantage of that, and how do you make sure it doesn't take advantage of you? How do you make sure it doesn't make your business obsolete? And then the other thing we see is technology. The rate of change in technology right now is incredibly fast. Things like cloud computing, which none of us even heard of, a year ago, is now all the rage. It's all anyone wants to talk about. May still be more heat than light right now, but there's definitely a lot of noise around it. And as you think about how you move that technology forward, because it potentially has huge advantages, that requires access to capital, at least requires liquidity. For me, it's not about raising cash when I think about taking advantage of the things I see in the external environment or protecting myself from the things I see in the external environment, because I can generate cash. But it's the ability to have liquidity, the ability to have options that the capital markets have created for us. It gives us the ability to make acquisitions with cash or stock, if I want, or with debt. But and being aggressive and seeing those opportunities in a very rapidly changing world, one that I think has probably been forever changed in terms of the way we think about how we build businesses, is what's critical to us. That ability to have options, that ability to take advantage of the opportunities I see and not have to worry about, can I get capital? Because that's the worst place to be in either a difficult environment or in one where you see tremendous opportunity. Because if there's tremendous opportunity, you have no access, you can't take advantage of it. In a difficult environment, if you don't have access to capital, sometimes you die. Right? I think that's the advantage that the capital markets provide for those of us who've been able to access it. But the only way you do that is by building a great business and making sure you understand what your opportunities are, make sure you take advantage of those. So that's really what we're looking at, is rate of change is a great thing for us. I want the rate of change to accelerate, not slow down. But we've got to make sure our business is smart enough to take advantage of that rate of change. And the capital markets give us the ability to do that either through acquisition, through raising money to go build software I want to build, whatever I want to do to make sure I take advantage of those opportunities that are getting created at a very, very fast pace right now.
Okay, thank you. Marty.
When I think of the external environment, in response to Harvey's comment, I couldn't move on to what the top two are until I address really the top three, and it's always clients, clients, clients. And from our point of view, very competitive market. Clients' demands are very, very high. If we don't do a good job for our clients, we're out of business. It's that clear to us. The other thing I talk about, just in the environment that we're in, we know we can't control the market, and the volatility of the market has such a huge impact on our business. And being a stable business matters a lot to our clients again. So again, what we do as an organization is control everything that is controllable, whether it be talent, product quality, or operational efficiencies. But really picking up, to this day and age, where are we? What's top of mind for us? We're a money manager. Financial services are regulated. They're regulated globally, and that is a top of mind topic and concern for us in the industry that we're in. And what you've seen after this market crash is that every country around the world has reacted in a way that you would imagine they would. They never, ever again want to see the consequences of what we've just seen come out of this crisis again. And what you're seeing in these different countries is they're becoming very parochial in their regulation. And as you're a global industry and a global money manager, it has become very hard to sort of navigate those different markets around the world. And I think if you come back to the United States and you think of the headline of what the principles of the regulation were meant to accomplish, and to take out excessive risk-taking, in particular around the banking industry, around deposits and the consumers in particular, I don't think many of us would argue with the headlines of the ideas. What is really happening is in the execution around the regulations that are being put in place and sort of the regulatory competition around the world, it is a real challenge for organizations. And what we find as a money manager, we weren't the focus of the regulation, but we're sort of a cousin in the financial services industry. So what we focus on is trying to make sure that our business is not disadvantaged by the regulation that's being put in place largely around the banking industry. The second area that I would hit, and it's probably broad and something it affects all of us regardless of the business that we're in, and that's really the financial health and responsibility of really all the nations around the world. It's a topic that's, again, we can't pick up a paper without talking about it, but the United States in particular, we're the largest economy in the world, we're the most developed in the world, we're a leader of thought, we're a leader of innovation, and if we can't get our become financially, fiscally responsible, the implications are obviously very severe to us as individuals, but also to any business that we're in. The business that I'm in, needless to say, that is really a very, very difficult thing. So what should we do about it? I think every one of us, regardless of your point of view, they'll probably all be somewhat differently. We have to get that addressed. I think that's the takeaway that I would take from there. And back to Harvey's point about capital, don't worry, if we don't get that right, we'll all have a really hard time getting access to capital to grow our businesses and create jobs in this country.
Thank you. I love that last part of the answer. Duncan.
Thanks for that handoff there, Marty.
Okay.
First, there's a bunch of external factors like there are in Marty's business for us that are completely out of our control. So we have to manage for them, and we have to do sensitivity analysis around them, and we have to do things like Mike and the JCPenney board did, saying, what if this happens, et cetera. But what I try to discourage my folks from doing is if we can't control volume, volatility, and the level of currency rates, all of which impact our bottom line dramatically, then we can run the models, we should understand the sensitivities. That's about all the time we really should spend on it because it's completely out of our control, and it's silly for us to pretend that it's in our control and that if we run more models, yeah, they'll give us a better understanding of what to expect, but it actually, we can't really control those variables. So we try to focus on the things that where we think we can at least have some influence or where we can have some impact. And the first one, which a couple of the panelists have already touched on, is we're all trying to figure out what the breadth and depth of financial re-regulation post-crisis is going to look like. And for a company like ours that has a footprint in a lot of different markets around the world, as I said to the students this morning when Marty and I did the class with them, on balance it should be good for us because a lot of the things that are being talked about being cleared or being traded or being reported, all businesses that we're in, they're products that heretofore we haven't been able to really participate in. However, it's beyond just the what, it's the where. Because as Marty also alluded to, different jurisdictions are thinking about this differently, and we have to make sure that we don't lean in one direction, in one geography where we think the outcome's going to be a place where we can win, and then find out that no one chooses that jurisdiction because 3 other jurisdictions that we didn't invest in set up a better framework where the model is more attractive to market participants. So we spend a lot of time trying to understand that as an external factor. Number 2, we're very focused, given the business we operate, on is there going to be a continued acceptance that the capital markets are global? Or is one of the reactions to the crisis going to be it's time to ring fence the borders and let's play protectionist games and let's try to create this external factor that says, no, we're going to go back to controlling our market and there's no more cross-border activity. I personally don't think that can happen. I think it's too late for some of the reasons Kevin cited, and they're good things, right? The world is too flat. It's too easy to co-create. It's too easy to do things virtually. Capital can flow across borders too easily. All of us may be patriotic. The fact is capital's not patriotic, right? Capital's going to go where it can get the best return on equity, and that's what we're all supposed to be doing with our shareholder hat on anyway. The third one that I think really affects all of us is what's the robustness of the economic recovery and what's the subsequent impact on access to capital for companies across the grid? As you've heard from several of the panelists, some areas of the market literally went on strike and were closed. So even good companies had trouble getting access to capital because a lot of the traditional sources they would have gone to were gone literally overnight. And I mean, I'm not talking about just companies on the edge of investment grade status, companies really across the board. So you really had a bifurcation where if you had cash on your balance sheet and you were financially flexible and strong, you were in great shape, and if you weren't, it was potentially fatal because there was literally nowhere to go. So given the role we would play, it won't surprise you to say our whole business is centered around connecting entrepreneurs and innovators with capital, then helping them access that capital. The capital formation process puts them in